Welcome back, value and dividend investors. Guys, today we have to talk about FedEx. FedEx is actually a really nice dividend grower because since 2002 they have been growing their dividends significantly. Although, I must say, sometimes when there is a tough time, like during COVID, they typically freeze their dividend. But you probably know what happened last Friday, right? The stock price tanked with about 20% on a single day. This means that FedEx is currently trading at a multi-year low not seen before 2019 and 2020. Hence, in today's video, I will share with you what's going on. And if you want to make an informed decision whether to buy FedEx or not, then please watch this video till the end. If you just expect a very bullish story on why we should all now double down on FedEx, then please stop here and go watch another video because this is not the type of videos I create. So having said that, let's get started, guys. So look, FedEx is going to report their earnings on Thursday the 22nd this week. But what they've done already on Friday, they really caught us by surprise with a profit warning. What happened? For instance, they're already mentioning to us that the diluted EPS for the upcoming quarter will be $3.33 compared to $4.09 last week. Generally not too bad, of course, a 20% drop or something like that, but that's not really why this stock was tanking. What it really was about was the tone of voice and the profit warning that they've been giving, because the first quarter results were adversely impacted by global volume softness that accelerated in the final weeks of the quarter. Effectively, what they are saying is that they have seen such a decline in the last few weeks of the quarter that they have to take on all measurements for all that is coming. They're really scared by it. Because what they said, while the company took immediate and decisive actions to adjust its cost base, the impact of cost actions lagged volume declines and operating expenses remained high relatively to demand. And they continue to go talking about this, about the weakness that they are seeing and that they are expecting it to only get worse, and they are aggressively accelerating cost reduction effort. What are we talking here then about cost initiatives? And I mean, just in a few weeks, they come with this whole plan. Reduction in flight frequencies and temporarily parking aircraft. Reduction of Sunday operations. Closure of over 90 FedEx office locations and even 5 corporate offices. I can tell you, this will impact really customer experience. And you know, this is not a high margin business. They are really sensitive to customer experience here. So this is really not good news, and that's why FedEx is also reducing their outlook. Actually, they're withdrawing their fiscal 23 earnings forecast. They expect business conditions to further weaken in the second quarter, and they expect the earnings per share of 2.65. Remember, it was 4.09 in the quarter last year, right? Anticipated capital spending has been reduced by $500 million to $6.3 billion. But they continue to buy back shares. I guess with the current share price drop, maybe they saw it coming. They still think it's wise to continue buying back shares. And I will get back later to this in a little bit. And you know, these forecasts are still assuming the current economic forecast, which has significantly worsened. You know, this doesn't mean even if we go further into lockdowns. And we know how China is approaching lockdowns in other areas of Asia, right? So guys, this was just a horrible outlook that they are giving here. And some big shots in the investing world were actually also called as the canary in the coal mine. Because, you know, usually when this kind of business is contracting, it really means something in the economy is going on. Because FedEx, as a company, also UPS, they are really sensitive to consumer spending and consumer behavior. So guys, this looks bad, right? But you know, if you have a well-managed balance sheet, you can actually deal really well with cyclical industries, like for instance post and express businesses like FedEx is operating in. We see it in other businesses as well. Think about T. Rowe Price. If there is a financial contraction and global economic recession, less people are investing, hence as assets under management go down and their earnings go down, but they have a pristine balance sheet. However, in the case of FedEx, this is unfortunately not the case, where they had a really nice balance sheet going into the 2007, 2008 and 2009 financial crisis. You can see hardly anything happened to their long-term debt. But what have they been doing since, let's say, 2012? Look at it. They had still a long-term debt of $1.2 billion. And this grew in the latest fiscal year report of 2022 to 34 billion. This is really insane, guys. And we can see that because their credit rating now is Baa2. This is really not good if you go into an economic downturn now with such a cyclical business. Because if we look at it, it is just like a lower medium grade, just 2 levels above junk status. Of course, there are other companies that have this as well, like Ahold Delhaize and other consumer staples, but their revenues are so predictable. This is really not the case here with FedEx, yeah? They are really severely impacted from a bottom line when shit hits the fan in a global recession. Now look, in itself, it doesn't mean that they are in a really bad place right now. Their interest coverage ratio is still 8.9 or something like that. They can easily pay their interest. But with this also increasing interest rate environment, this could change rapidly quick. And what is the pity here? If we look at their most recent financial targets that they just released to us in June, they were expecting a 4 to 6% compound annual revenue growth for the next few years. An adjusted dividend payout ratio of at least 25%, but also a ratio of capital expenditures to revenue equal or less than 6.5%. I will get back to this in a minute. And a compounded annual growth rate for adjusted EPS of 14 to 19%. So this has been thrown into the bin. There's no outlook going forward. They've withdrawn it. Maybe they get back to this anytime soon, but the new CEO is definitely speaking with a different tone right now. So next year, June 2023, the CEO will have to give an updated outlook again, which will probably look a bit worse than what it was this year. Let's see. I really don't know how the economy will do, but according to him, it will be really, really bad going forward. But Hey guys, sorry for this quick interruption, but I really would love to show some appreciation back to some of my most loyal followers. So here we go. Mark, Lukas, Xander, Mr. Someone Anonymous, Alan Mulvey, Thiago, Mike, Engineer My Freedom, my buddy, Alexander, nice to see you here as well, and Many Mystery. Thank you so much for buying me a coffee. You've been supporting me and you're supporting me. I'm currently already at 56% of my goal to meet my buddy, Engineer My Freedom, with whom I'm running the Dividend Talk podcast. So if you would like me to face-to-face meet Engineer My Freedom for the very first time ever, then you can do that by sponsoring me by buying a coffee to reach my goal. That was it. Thank you so much. Let's get back to the video. But the issue really with this company is not just its debt. The debt is really just a result of poor cash flow. So if we look at it over the years, over let's say the last 10 years, they have been making 27 billion in net income. If you sum this all up, 27 billion, right? But at the same time, they've only been making 10 billion in free cash flow. You can see sometimes even negative free cash flow. Why was that? Because their cash provided by operating activities is barely covering their capex. And this is really the issue because this is a really highly capital intensive business. So this company, to stay competitive to UPS and don't forget Amazon, needs to invest heavily in its assets. And it's costing them lots of cash. So even if the net income looks nice, we don't see this turn into cash. Also on top of that, they bought TNT Express for 4.6 billion. Back in 2016, we have yet to see really an increase in their cash flow due to that acquisition. Of course, there has been one gift and that was COVID. We were locked down. I mean, we all needed FedEx, but I treat this as a one-off, as we have seen with so many companies. Yes, some of this will stay. Maybe 2 billion or something like that. But generally, it will go down again, in my opinion. So having said that, the difference in free cash flow compared to net income is about 17 billions. On top of that, they have also been doing 14 billion in buybacks, share repurchases, right? If you sum this all up, 14 billion, plus 4.4 billion for the TNT Express acquisition. I mean, it should really come as no surprise that this company has been going from hardly any debt all the way to 34 billion. And this is really how the company has been growing over the last decade, just by leveraging up debt. And the issue with this is that it doesn't have so much flexibility anymore, in my opinion. Yes, the dividend is nicely covered still today. I even believe it's safe, but it's really at the bottom line before it becomes questionable. Yeah, look at it. Debt to equity currently 139%, going potentially in an economic slowdown. This is not good. What the company has really in its favor is that it has a really conservative dividend policy because it's trying to pay out approximately 25% of their net income. And even funny, when you read the whole reports of FedEx, they are never mentioning free cash flow. And we all know why that is, of course. So guys, a company with a weakening balance sheet and a poor free cash flow doesn't mean it's uninvestable, right? Because if you think about it, the net present value of a company today is simply its sum of its future free cash flow. And that's the philosophy that I really follow because as an investor, we want to get cash out of the business. So if we go then, right, actually, if you look at the key statistics, it all looks green. And it is green because of the dividend growth that we have been seeing, a proper dividend yield by now. It's meeting the 2.75 criteria. Also, the multiples are low really at the moment, 11, 12, 13. But of course, it's yet to be seen how this will look next year, of course. But even revenue has been growing. Free cash flow has just not been properly growing. And I've not even been able to calculate it because they had several years of negative free cash flow as well. But then it comes really to the balance sheet and that they are hardly creating shareholder value because the return on invested capital is just 2.6% above the weighted average cost of capital. This is a really slim margin. And if we really see a severe economic slowdown, probably the company goes into the minus here. But now it comes then, right? What is this company worth today? And I really struggle a little bit with this. If I go for free cash flow, the company's value will look much different than when I go with net income. If we look at the free cash flow average over the last 5 years, we're talking about 1.136 billion. If we then take a growth of approximately 6% and 3% thereafter at a discount rate of 12.5%, terminal multiple 15, in my opinion, the company is just worth only $58. And that's where it really becomes awkward, right? Because the company is currently trading at a share price of 161. And actually, if we take an optimistic case, in June, the CEO was estimating a 14% to 18% annualized growth until 2025. So let's take that, plus an 8% growth thereafter, again with a similar discount rate, but a slightly higher terminal multiple of 17. We would say that the fair value of the company would be $92. So of course, these prices are way off. But this is really the question here. What do you expect with the free cash flow? Do you expect the free cash flow to be there that we have seen during the COVID years? Or do you expect it to be seen from before? They are expecting a 6.3% capex yield based on their revenue. Let's assume that their revenue might be still 93 billion. We're talking then here about 6 billion, 5.5 billion capex annualized on top of a 6 billion, operating income from cash flow. We're really talking about $500 million to $1 billion again, right? That's reality. But okay, if you believe that they need to invest that today to stay competitive, but it's just like an investment still for 1 or 2 years, and after that, the free cash flow will really go up and we will see more like cash flow in line with net income, okay, we can model that as well. So let's go here. Let's assume the net income. Let's take a 3 billion, yeah? Let's take then also a 6% growth and a 4% thereafter for a terminal multiple of 15, and we get a fair value of 154.92. This is way more in line with the share price today. So guys, for me, FedEx is really tricky company to invest in. I haven't even mentioned about some of their retirement liabilities that you will find on the balance sheet. Goodwill doesn't actually look too bad, but okay, you can still model for that. The question really is, do you think that this company can generate sufficient free cash flow so that it will not need to continue leveraging up the balance sheet? For me, this is a trend that is really hard to reverse because this is such a competitive landscape, and that's why, for that reason, I will not touch FedEx at all and far stay away from it. If anything, I would rather look at their competitor, UPS, once the share price is more in the value zone to me. Guys, this was not a bullish video, I realize that. Please, if you disagree with me, mention it really in the comments of this video below. And if you agree with me, please also, but always let me know why, because that makes us all better investors. Guys, if you like this video, don't forget to subscribe. If you've done that already, hit the like button and see you next week.